Alrighty. What's up? What's up? I'm going to talk about the 10-year yield real quick. We're just going to keep it the 10-year to keep it simple because it gives the most information here. And I want to go into all the different yields or the yield curve inversion and how everyone's talking about that. I do think that it's signaling a recession, but just not this year. Okay? Just get it through your thick skulls. Just not this year. We're touching a 15-year trend line here from before the financial crisis, 2007. Touched it here and touched it here. And if you look at this, okay, we're having the first oversold monthly print ever going into the zero line. Okay, it's on the zero line right now. I don't know how this month ends. I would love to see this close above this going into the end of the month next week. We got 4 days left. I would love to see this. You would expect to see it rally out due to the rebalancing of the end of quarter, end of month. We shall see if it happens. And if that happens, you're literally bouncing off of this. You're literally bouncing off of this. You cannot break this without some sort of a rally off of it. And the fact that it's on the zero line, you could and you should get some sort of a violent move off of this. You could and you should get some sort of violent move after this. I think that the 10-year, I think yields are going to go up a lot. Yields will go up a lot in the next couple of years. I'll show you why. I think this trend line will break in the future. I think this will break the Treasury note. I think yields will go up a lot based on how everything looks. And it will put a lot of pressure on the stock market, which I think happens in 2023. And it'll make things very uncertain in the market. What you want to be aware of is that when the stock market corrects, as I expect to happen this summer, give or take, the Treasury note explodes. Okay, when you have a violent move down in the market, this thing will rip, just like it did with COVID. Okay. And it's set up for it. So if this activates here, March, April, and then you get the residual kickback, April, May, June, July-ish, whenever, however, if that activates, you're going to get a violent move. It's going to be the energy of this entire move here. If we're breaking this, which I think we will, the kickback that you get here should be violent. Violent, violent, violent. Which means that this is a stabilizer. This is violently shooting downward, trying to stabilize the momentum to the downside, allowing it to rally. That's what this very well could be. We find out in the next couple of days, weeks, if this is going to hold out and play along. The yields here, I think, are topping out here. You're going into multi-year resistance here. 2000, 2007, 2018. And we're coming in hot. Right around 2.7. Already at 2.5. This touches the zero line in April, which would definitely put pressure onto this. It doesn't need to wait for April to start going lower. So again, I think that these are topping out. It'll help tech. It'll be a headline to help tech. Whether it actually helps it or not in the interim, it doesn't matter. I still think the market's going to rally out, and yields will be a story to help it. That yields finally topped out, and they're coming down, and it's going to take pressure off the tech. Blah blah blah. If you look at the yearly on the 10-year. Okay, we're about to get a yearly MACD cross for the first time ever. For the first time ever since 1997. It did a little cross here and got rejected. What I think actually happens is this actually goes green, and when it goes green, it's going to have a violent spike. For this to go green, you're going to see a very violent spike, a very specific day where yields scare people or people are talking about it. Okay, and when that happens, I think it's going to rest. So it's going to get rejected, not do this, but it's going to get rejected, and then somewhere into this year, next year, it's going to activate again. And I think we're taking out this upper trend line. I think we'll take out this upper trend line. The upper trend line represents this downtrend in the MACD. So you kind of end up figuring out where and when and how it can break this. Okay? If you think that you're going to go into this and go right through it, you're mistaken. Things don't do that. What would happen at the very least is it'll go up into it, it'll get rejected, and then it'll spike through it. And I think it's going to get really rejected with the correction. This may even cause the correction. If yields actually break out this year and break this line, that would be the yearly MACD cross, and that would be yields are going too far, too fast at a certain period of time, right? So let's say yields do this, and then yields go up and up and up and up and up, and everyone starts getting scared and scared and scared, but the market keeps going higher. Everyone's like, all right, yields are going higher. This is the thing everyone's scared about, but the market just keeps going higher. Is it ignoring it? Then you'll get everyone talking about how they're ignoring it and blah, blah, blah. And this is how market tops happen. They confuse you. They don't talk about it in a negative way, so people feel happy, and then like the big bad black swan happens. How far can it go? How fast can it go before the market actually feels it? And that's how market tops happen. They happen in a way that you can't really pinpoint. There's not a specific click where, okay, 2.8% is the level, 3%, the inversion's the level, right? There's no specificity to it. So that's what I would look for. This would be one of my triggers in the stock market for this breaking it, which would break it on a yearly basis, and then the market would correct, and then it would get really, really violently rejected. It's kind of the psychological rejection of yield breaking decades long trend lines. So the market would be like, oh, I don't want to do that. I don't like that. It doesn't feel right. And it'll be represented in so many different stocks and ETFs. It'll be represented in the way they are, their proportions, their ratios, and their levels. And you'll see. I don't know how low it goes. I don't know. I don't care. But once it gets rejected, it will go back above it. DraftKings. It will go back above it. And I do think that is very, very well a cause for the short recession in 2023, like 6 months worth. I could see it breaking this. I actually think it's on a collision course breaking it, 3.248. So these are the yields. You need to be aware of where we're at right now and how the bond market's going to affect this. Quarterly. This will break eventually, and eventually it will retest this somewhere in the future. And this very well could be, if we get the market correction, wherever this goes. However, the big market correction could be this retesting a 15-year trend line in yield. And treasury note, same thing with yields. If we break this, let's say we break this, whatever, and we get above it, 24, this could very well be the retest. I mean, if we drop, I could see it's actually dropping to this. There was a massive amount of psychology and wave dynamics around this, breaking this 10-year trend line. I could actually seeing that happen. Something like that. And then you have a higher low and a higher high. And yields will be in an uptrend for the first time in a million years. It'll be in an uptrend. And that's how that works. So I just want to mention that. Everyone freaking out about yields and what it's going to do to the economy and how it's going to affect it. On the charts don't show that it's going to cause a recession this year. It looks like this is about to top out, and yeah, don't get too freaked out about it yet. Not yet. Not yet. Alrighty.